What's up, everybody? Josh Bennett here. So the Fed basically came out and said that they're going to slowly start tapering off their bond purchases. So this is a really important thing that's going on, but it's kind of a complex situation that a lot of people don't really understand. So I want to paint some light as to why this is important. So basically, what's been going on for pretty much ever since the housing crisis in 2008 is a program called essentially quantitative easing is what it's been sort of checked as since 2008. That's kind of the name it goes under. But basically, what the federal government is doing, or the Federal Reserve, is doing sort of a experimental economic policy where what they've been doing is they've been purchasing a bunch of bonds out from the markets. And the reason they're doing this is because money was tight and people weren't spending a lot and things like that. And there were reasons that the federal government wanted to basically input cash into the markets. And the expectation was with more cash in the markets, businesses will spend more on innovation, pay their employees more. People in just the general public would spend more money just buying things, aka stimulating the economy. So what the Federal Reserve has been doing has been basically buying billions of dollars of bonds, aka taking those bonds and putting them on their balance sheet and then putting the cash back into the markets. Well, this may come as no surprise what we've seen recently over the past past year or so, and was originally supposed to be very transitory, still may be transitory, where the Fed may see this sort of disappear. But right now, what we're seeing is a lot of inflation. So if you're not familiar, we put out videos on inflation, and there's lots of good information on inflation out there. But basically, what inflation is the steady erosion of your dollar, of your purchasing power. So the old adage is like you and your grandparents talk about Coke used to be 25 cents back in their day, and now it's like $3 for a bottle of Coca-Cola. Well, yeah, something's obviously changed there, and what it really is inflation and the deterioration of the dollar. So, that being said, inflation has increased pretty drastically ever since COVID started. The reason for that is we've had to dump a bunch of cash into the markets. There's been supply chain constraints and things like that have sort of boosted the price of things. And the price of things is what really causes inflation. So what happens is if you have too much cash in the market and inflation starts running out of control, well, the Federal Reserve is forced to take some actions. And what they're forced to do is basically cut off the easy money supply. And the first way that they've decided to do that is to cut off the easy money supply via slowing down their bond purchasing. By the tune of about $15 billion a month. So that's about $15 billion a month less cash that's going to be going into the markets. In the scheme of things, when you're looking at a U.S. government that's, debating over a $2 trillion package, right now, $2 trillion package compared to a $15 billion, well, $15 billion is kind of a drop in the bucket at that point. But, long story short, it's still money that's getting pulled out of the markets. This could have a detrimental effect on things like bond yields. It could have a detrimental effect on stock market. It could have a detrimental effect on interest rates. All these different things can be, there's not necessarily a direct correlation there, but weird things can happen when you start, changing, especially experimental monetary policy. And so we don't really know what's going to happen. Right now, what we do know is that stock market is pretty highly valued. I'd say there is a pretty big risk that if you stop pumping that market with cash, well, there's nothing going to be able to push those values up higher and higher. So I think what's been happening over the past couple months, and we've talked about this before in videos, is that the stock market's been basically, all this cash that the Federal Reserve and the government has dumped in as part of a stimulus package with COVID. They've now had to, that money's got to find a place to sit somewhere, and it's dumped into real estate, it's dumped into stock markets, etc. Well, now that the cash is slowing, we could see expectations for the stock market change, and people ultimately start trying to find some other place that's less risky to put their assets. So we could see the stock market pull back. Is that going to happen? We don't necessarily know, or necessarily know when it's going to happen, but it is a concern because the stock market is based, especially these days, on future growth expectations. If those future growth expectations disappear, who knows what could happen? The most likely scenario is that you will see a stock pullback, you may see a crypto pullback, you may see a real estate pullback. So these are all things that, excuse me, could happen. So that's where it's worth understanding and really paying attention to what's going on with the Federal Reserve over the next couple months, because they have signaled that they're for sure going to slow down bond purchases, and they've made indications that they're also going to start increasing rates directly with the Federal Reserve rates here probably by the end of the tapering, which is expected to be by June. So we could see the interest rates increase by as soon as June, if not even sooner, depending on how inflation increases from here. They don't think that it's going to be that inflation's going to change compared to the known quantity it already is, but it is a possibility anything can happen. So we may see interest rates go up sooner, but I would say most likely they're going to go up in June at this point, based on the indications from the Federal Reserve. When interest rates start going up, you will start seeing more direct correlations to things like margin loans and home equity line of credits and mortgages and things like that. And that's where you will start seeing, I think, greater pullbacks as we get closer to those dates. But this is a scenario that's definitely worth paying attention to because it could have a large impact on asset classes of all different types. But hopefully you found this video valuable. Make sure you like and subscribe, and we'll see you next time. Cheers.